Hello, welcome to the DMV Roundtable Podcast. I am your host, Jose Barreto, and with me here today is my boy, John Walowac of the Yi Team. How are you, John?
I'm doing great. Thanks for having me.
Yeah, thank you for coming. And how are things going?
It's busy times.
Busy?
So, yeah. Activity in the market's picking up, and family's always busy.
Yeah.
So
how's the family?
Great, man. They're doing great.
Yeah. But anyway, so tell me a little bit about where you work. You work for the Yi Team, right?
Yeah. So I'm a senior loan officer with the Yi Team. Been there with these guys for about 4 years. Fantastic group of people. The Yi Team is the gentleman who runs us. His name is Chong Yi. He's a
fun dude.
Crazy Asian dude, always strumming his guitar, running around, very knowledgeable about the mortgage business. So,
what's up, Chong?
If you're out there, Chong, we love you, buddy.
Yeah.
Sometimes we love you.
Yeah, I had the pleasure of meeting him. He's a really good dude.
Yeah, he's awesome. And cool. The whole team is just a wealth of knowledge and very professional people. So yeah. Lucky to be a part of that.
Yeah, cool. Tell me a little bit about the market. What, coming into the spring season, what can people expect? I know, people are always talking about rates. Let's get that out of the way. How are rates right now?
Rates are historically very good. I think they're probably, mid to upper sixes for most stuff. Okay. There's always changes going on. We got new conforming loan limits. We got...
What are those? Let's go. What is the new conforming loan limit?
For the metro area, I think it's 806,500. So it's gone up substantially since I've gotten in the business. Yeah. I remember it was 428 or something like that. Yeah, it's double.
So it's 806 right now?
806,500,
wow.
I believe. Yeah.
Wow. Okay, so and the importance of that is what? You get better rates, right? If it's under that number?
Yeah, conforming limit, anything at or below that, you're generally going to get better terms.
Okay.
Than something that's above that, whether it's high balance or jumbo type.
Right.
Yeah, so.
Okay.
Yeah.
All right.
And then, programs and stuff, we're always learning something new. They're always putting something on us as far as, bridge loans that we can talk about, or a lot of good grant programs that we have access to.
Let's go through some of the grant programs for first-time home buyers. Let's just dive right into that. I know that people who are looking to buy for the first time, obviously, a lot of them, the money's not 100% there, so sometimes they need help. So tell me a little bit about what's available for those first-time home buyers looking to dive into the market right now.
Sure. So first thing off, first-time home buyers isn't somebody who's never owned a home.
Okay.
It's someone who hasn't owned a home in the last 3 years.
Okay.
So just because maybe you owned a home, 7 years ago, it sold it 5 years ago, you are now considered a first-time home buyer again.
Okay.
So that's kind of one. Program-wise, there's all kinds of different programs that are out there for grants. They're forgivable grants that, have a 5-year forgiveness program. There's through the state, a whole bunch of different stuff. But the ones that we've gained access to in the last year or so, there's a first-time home buyer program where you can get up to $17,500 towards down payment closing costs and down payment, which is different.
Up to 17,000, you said? Up to
17,500.
Okay.
Okay, and that's for, basically if first-time home buyers to make 80% or less.
And how does that work? Is that a loan or is that forgivable? How does that work?
So the first-time home buyer grants is forgivable after 5 years.
After 5 years,
yeah,
okay.
For this specific program.
So meaning if you keep the home up to 5 years, if you don't sell before 5 years.
Correct.
Got it.
Correct.
Okay.
And if you did happen to sell, I know there's a proration they use where, like, if you got 17,500 and you sold it after 4 years, I think there's a kind of a formula that they use to figure out, hey, you may be liable to pay this back. We don't normally see clawbacks on that type of stuff, and that's what we call it. But
okay.
So
I see. All right, and then you also have some special stuff for teachers and. Go ahead.
Sure. And so we had another program. It's called Community Partners, and that's for teachers, firefighters, policemen. There's a whole myriad of different occupations that allow for this grant. It's up to $20,000.
It's up to $20,000.
Yeah, and again, it's 80% of the area median income or below.
Okay. So you have to be earning 80% of the area median or less.
Correct.
Got it.
Correct.
Okay.
Yeah, and so that's another great program to help out our people that work in the community that help us help our kids
Sure.
and
Super important. Yeah.
yeah, you'd love to be, especially now as competitive as the market is, and properties are expensive. Anything we can do to
Properties
help.
are expensive. Closing costs are expensive.
Yeah,
So
yeah.
you just want to make sure that you either have all the money, or if you don't, you can get a grant to help you out.
Sure. We
Okay.
can definitely look into that for people.
Okay. All right. How do you determine? And again, the three main types of loans. We're talking conventional, FHA, and VA. How do you determine when somebody goes FHA or conventional? We'll talk about VA in a second, but FHA and conventional, people always have that question about why would I go FHA? Why would I go conventional? What are the pros and cons of each?
So FHA loans is a government loan. Those rates are generally a bit lower than doing a conventional type loan.
It's insurance, right? FHA is an insurance type.
Yeah, FHA has what's called an upfront mortgage insurance premium.
Okay.
It's almost 2%. It's like 1.75% of the loan amount, and that gets added to what you owe.
Right.
So conventional loans don't have that either. So
Okay.
conventional loans, if your loan amount's $300, that's what it's going to be.
Okay.
So there's no addition. There's no funding to the loan amount.
Right.
The other factor is typically we're looking at credit scores. Credit scores usually are going to dictate, not always, but usually are going to dictate which type of, whether it's FHA or conventional, we're going to go
So the better credit score, they will go where?
conventional.
Conventional.
Yeah.
Okay.
And the main reason for that is private mortgage insurance is the type of mortgage insurance that you get when you have when you take out a conventional loan and you're not putting down 20%.
Okay.
And that type of insurance is much cheaper for people with better credit scores.
Okay.
Whereas people that have lower credit scores, FHA's mortgage insurance is more of a one-size-fits-all approach.
Okay.
It's a little bit more expensive than if you had better credit scores and were able to go conventional.
Right.
But
You are a bigger risk. That's what I'm assuming, right?
yeah, but it ultimately comes down to what the monthly payment is too.
Got it.
Yeah, with the FHA having lower interest rates, it's usually what we're doing is we're giving people all the options and going, hey, look, these are the pros, these are the cons of going this way, and helping them make that decision. So,
Got it. Okay. And then with VA, I mean, we know those are for veterans, and those typically carry little lower rates,
correct.
don't they? Yep.
Yeah. Again, it's a government loan. It's got the interest rates are going to be lower on those.
One of the best things about it is that no down payment, right?
Correct. No down payment, and no mortgage insurance.
No mortgage
No
insurance
mortgage
either.
insurance. Yeah.
So what do you use to qualify? So to qualify a person, you use their income, or how do you qualify somebody for VA?
For VA, it's different than the other types of loans. It's not really a debt to income calculation for
Okay.
VA. VA has this thing. It's called residual income. So for typical loans, once you're looking at like around 50% DTI as a cap for like a loan getting approved. You can go a little higher FHA. But VA, there really is no cap.
There is no cap.
There
okay.
really is no cap. If you meet what they call residual, and it depends on your family structure and the size, you might have the VA puts this information out, obviously, but you might have a family of 4, and the residual that you need is $800 a month. I'm just throwing that number out there.
Right.
So after all of your bills, car payments, credit cards, whatever, including the prospective mortgage. Yeah, if you have that amount of money left over,
you qualify.
Yeah, you're going to end up qualifying with
Okay.
everything else being equal. I mean, that's pretty much how it's going to.
So see, this is why it's so friggin' important for people to go and get pre-qualified and pre-approved before they start shopping for a mortgage. Whether you're VA, FHA, conventional, it doesn't matter. Just go ahead and get your numbers straight.
Yeah, you want to know. You want to know. I remember the first time I bought a house. This was a long time ago. You can probably tell by looking at me. But I remember walking into the closing office, not knowing what my payment was, and not knowing exactly how much money I needed to bring.
Yeah.
So knowing that up front, it's going to mitigate a whole lot of anxiety that there is. I mean, people are buying houses. It's hundreds of thousands of dollars. I mean, you need to know. You
Yeah.
need to get that up front and figure out, hey, does this work? Do we
Right.
feel comfortable with what we're doing here?
Right,
So-
right. Tell me, what is an origination fee?
So origination fee, I mean,
And again, we're going to dissect a little bit about closing costs here. So before you go into that, I'm just going to ask for a few things that are going to be normal in closing costs. But obviously, we're going to talk about lending costs with you. In another pod, I'm going to be talking to the title companies, talk about title fees and stuff like that. But
Sure,
I want to go over some of the lending stuff that people can expect so that they understand what the where the closing costs are coming from. So I'm starting with loan origination fee because I get that question sometimes.
yeah, originate what it is, or you want to know how much it is?
Give me what it is
Yeah, I
first,
mean,
and then just tell me, how you guys calculate that cost.
Yeah, so origination fee itself is usually a set charge by any bank.
Okay.
It's not based upon the loan amount, it's not based upon any of that stuff. And it's going to cover basically the underwriting, the underwriting costs, processing, all that stuff's going to be up there for origination.
So is the charge from the bank to produce the loan?
Correct.
To put together all these pieces, all these people that work, they need to charge so that they can put together the loan, right?
Yeah. And typically most banks, those are salary employees, so that money goes to pay
To pay that,
to
yeah.
pay their salaries.
Got it.
Yeah. And so we're going along with that with the lender's costs. I mean, we have to order appraisal.
Right. The next one is an appraisal.
Correct.
And roughly, what are you looking at? I mean, just give me an estimate.
I mean, most appraisals are probably going to be anywhere from
600
$600 to $700. They can go up depending on the amount of work that the appraiser is going to have to do
Right.
For a specific property.
Right. It's appraisals are not priced based on sales price. They're priced on how much work the appraiser has to do. And a lot of people, don't get that concept, but or don't know that that's a thing, right? If an appraiser is doing an appraisal in a condo that doesn't take them that much of an effort, right?
Sure.
They can't, just because the condo is $2 million doesn't mean that they can charge more for that appraisal.
Correct.
Yeah.
Correct. Yeah. It's basically the amount of time.
The amount of time. Yeah. Okay, so you have that. You have a credit report fee. Sometimes that gets charged too, right?
Yeah, correct. Yeah, usually it's around $125, $150, something like that, depending on. We can't. The thing that people need to understand is banks. We really can't charge more than what
it costs
we can't
you.
charge more than what it costs us. So if
Yeah.
appraiser says, "Hey, I'm going to do the appraisal. It's $625." We can't charge
You
more.
can't charge
Yeah.
you can't upcharge that amount, right?
Nope.
Okay.
None of
Same
those
with the
fees.
credit report, right?
Correct,
If
correct.
you're being charged $50-$60 for a credit report, you can't charge $100.
Right.
Right.
And guys, banks aren't in the business of losing money. So they're going to typically, when you see a estimate, that estimate's going to be a little bit high in the beginning. And then that's, then they work towards that final number based
Right.
upon what those fees from, an appraiser costs us. You know what I mean?
And again, this is why I tell my guys, hey, go ahead and get a good faith estimate from your lender so that you can sort of see what your cost is going to be. And typically that's higher than what it turns out to be,
Yeah,
right?
yeah,
Unless there's an unforeseen expense, right?
Correct. But the other thing is, like, if we said, hey, the appraisal, if you get an appraisal $550, and we put that as our estimate, and the appraiser comes back and says, hey, it's $650, the bank has to eat that cost.
The bank has to eat it.
Banks are not gonna want to do that. So they always estimate a little bit high to cover that, and then they'll, based upon what the fee actually is, adjust it. So.
Right. Then you guys typically have a processing fee, right?
Yeah, there's always a few different fees that are in there, but most banks are, pretty. I think all in on a lot of that stuff. The origination stuff is
Covers.
around $1,500 or $1,600. Yeah.
Okay.
Yeah.
All right. So then those are the main fees that you're looking at when you're looking at a lender fees, right? Which
Sure.
is the first part of that HUD, that final settlement statement.
Yeah, well,
right?
we use we look at a loan estimate and a closing disclosure. We don't look at the HUD too much, but I know you guys love it. But
Especially the CD, closing
yeah,
disclosure.
yeah.
Okay. All right. So that's good. I wanted to go over that. Talk a little bit about the process. What people should be asking you, or what people can expect during the process of their loan apply all the way to closing? What?
Yeah, I think the most important thing that people need to understand is in the very beginning, the more that someone in my position knows, the better we can help. And getting you in a spot where you're looking at the type of property, where the monthly payment based upon what you want to bring as far as down payment, the money that you have access to, so that you're looking in the right price range, and then you know what to expect. You know my payment is going to be blank a month, and you're comfortable with that.
Right.
So that pre-approval process up front, having those conversations, and knowing, where you're going to fall in is really the most important step. And then once that's completed and your pre-approval is done, then you're out shopping for homes. And that's where, like for me personally, I like to be very involved in that process, and then helping them get the home. You find the home you want, boom, you're going to put in an offer, it's blank amount, and, a lot of times.
And by this point, you have already prepped your clients as to what you're going to need from them, right? Once you find a home.
That's in the very beginning. That's during the pre-approval.
That's very important because that way you can get them to get their stuff ready, understanding that you're going to need them during the underwriting process, right?
Yeah, and we're not like a lot of banks will just take an application based upon what someone says.
Right.
We're not doing that. We're taking an application and we're saying, hey, we need. In order to complete your pre-approval, otherwise it's just a pre-qual.
Pre-qualification.
Yeah,
right? Pre-qualification is very different than a pre-approval.
That's very loose.
Yeah,
very loose. Mm-hmm. Pre-approval, we're getting your pay stubs, we're getting your W-2s if you're self-employed, we're getting your tax returns to validate all the income to make sure, because our job isn't just to get you in. Our job is to protect you from putting you in a spot where, you could be at risk for defaulting on a contract or something like that, and. It's not just getting a loan. It's protecting our clients.
Sure. Okay, they get the home. They get the contract accepted. Now they're under contract. They go to you, and then this is where you start collecting or you've already collected some as you said.
Right.
But you will put it through underwriting. Underwriting is likely to come back with some stuff, right?
Yeah. So first thing that's going to happen is we're going to have the initial. Hey, congratulations, awesome job, you're under contract. And in this market, that's a big deal, getting someone under contract. And, and then I'm going to be basically, my assistant, Krista Fitch, she's incredible, is going to step in. I'm going to tell Krista, hey, this is what we got. We're going to need, this, and this. She's going to reach out to the client. We're going to get those documents. And Krista really works back and forth between processing and underwriting to make sure that everything goes smoothly for the client.
Sure. Okay. All right. Very good. And then once you get conditions, then she goes back to the client for whatever else underwriters.
Correct.
Because sometimes underwriters are going to want clarifications on some items, right, and things like that.
Yeah. Anything that's a gray area, and usually we're trying to get that up front.
Good.
If there's a job gap or if there's a question about. Yeah. Anything, we're trying to get that up front so that so everything goes very smoothly.
Sure.
Yeah.
No, and that's obviously the right way to go. I just want to make sure that people, don't think it's going to be perfect, because I think when some of the people that freak out during the loan process, especially if they've never been through it before, is because they don't expect. Oh, you need a letter of explanation for this, or you need to tell me why this is on your. Things do get caught, that sometimes can catch somebody off guard and can freak out a buyer.
Sure. I mean, there's all kinds of things that come up. Gift letters. It's the kind of thing, maybe they're getting gifted something from a family member.
Yeah.
But, that's where up front, I'm asking them, I'm saying, hey, look, you're going to need blank amount of money for closing. Where is this money coming from? And I'm saying, okay, can you send me those bank statements? And then if there's a shortfall there, I'm like, well, you're showing me you have this. Where's the rest of the money coming from?
Where's the rest of the money?
I'm getting a gift from, so-and-so. And so we're going to, we know what's coming down the road.
Right.
And preparing them for that.
That's great. So, yeah. Good. And then I know that you are one of the, well, I wouldn't say, lately you're one of the few lenders that show up at my closings.
Oh, wow.
Which I appreciate, to be honest.
buying a house for people, it's a big thing.
It's a big thing.
I want to stand behind what I do. Sean?
Why did that go away? Why would you say, why do you think that went away?
I have no idea. I know there's a lot of people that do what I do that don't show up at the closings.
Yeah. I don't understand it. And, I don't understand why not show up.
I just love that personal interaction. People put their trust in me to help them and give them the best advice I can. I feel like, I don't make it to every closing, but I do my best.
Yeah, you do your best to
stand
go
behind what I did.
I mean, I tell you what, it does two things, I think, that are important. It puts my mind at ease a little bit and my client's mind at ease a little bit, because if there's any question regarding lending, most of the time there aren't, right? Everything has already been disclosed 3 days before.
Yeah,
talked
17
about
times.
To death.
They've seen the number 17 times.
I get it. But you and I both know that once in a while there's somebody who goes, I didn't see that, or whatever the case may be. And having the lender there is money, is great. So, I want to say you pretty much always go to your closings with me. So, and I appreciate that.
Yeah, my pleasure, man. Well, you put trust in me to help your clients. And I'll do whatever, whatever I can to support. So.
Let me ask you one last thing before I let you go. Investment loans. Do you do loans for investors?
Yeah, we do loans for investors. We do bridge loans, and I think that's a big.
Okay,
the bridge loan.
Say more about that.
Yeah, so the bridge loan stuff right now is really, I think, an underutilized program.
Okay.
You have a lot of people that maybe they're not quite happy with where they're at the moment, and they want to move, but they don't want to, they may, have a bunch of equity tied up in their property, and they don't want to, sell and then be looking around for a house.
Yeah.
I had a client just the other day, it's a perfect scenario. She's going to have all the money from the bridge loan to make a cash offer on another property, in this market, as competitive as it is, if you're getting if you're going to be able to go, hey, we're going to pay for this in cash, and
with the sale of my other home, so you have to wait until that closes.
Yeah.
That's where the problem is.
Yeah, but the bridge comes in where they're going to loan. It's kind of specific scenario, but usually it's up to 80%, loan to value. So if you had $1 million house and you owed, $400,000 on it, you're going to be able to tap into about another $400,000, or there maybe even a little bit more.
Boom.
To go, to move forward on another property with.
Right.
So as opposed to putting your house on the market, getting on the contract.
No, and then if that's useful, because if you're selling your house and you need the proceeds to buy the other house, then you don't have to put a home sale contingency. Correct. If you have a bridge loan plan in place.
Right.
Right. It makes your offer stronger.
Correct.
Right.
Yeah.
So, yeah. And then for investors who are just looking to just straight up buy investment properties, what sort of programs do you have? Typically what's the lowest down payment that you've seen?
I mean, you could get low down payments as low as 15%, 20% but to be honest, they're not. The terms you're going to get on those are not real good.
Unless you put more money down.
Yeah, 25% down is kind of the normal.
Okay.
And you're going to get much better terms, coming to the table with that type of
What would be ideal, would you say, for an investor? 50% down? Would that be ideal?
I think 25 to 35% is probably, pretty good if you have that type of money, depending on the property. But, and that just helps out, with, additional costs, like points and stuff like that, not having to pay those. So...
Right.
Yeah.
Now, and you do also construction, like 203K loans, FHA 203K.
We have access to 203K loans. Yep. I don't particularly do a ton of those, but we do have access to them. So.
Okay. Yeah, I just got asked about that a little while ago, so I always have to ask. The range of clients that I have just vary from first-time home buyers to seasoned buyers to investors to people who want to buy land and build and all sorts of stuff. So
yeah, well, you've asked enough questions. I got a question for you. So what are you seeing out in the market right now? Are you seeing inventory in a good spot, or do you think?
No, inventory is still crappy. I mean, obviously it's super low. But the fact that 72, I think the number is 72% of mortgages are under 5% right now, keeps the market stuck. I mean, because if you're going to replace the home that you have with another home, whether you're upgrading or downgrading, like let's say you're retiring and want to sell your home, and then you want to buy a condo or buy something smaller, or the other way around, if you're married and now are planning on having children, you want to move up from that condo to a townhouse to a house, and you've already bought, then selling that property that has a 3% interest rate to buy another property, whether it's the same price or even lower, you're still going to pay more. So that continues to keep people stuck. However, we are now at the 5-year mark from COVID, right? Or around there,
right,
in that range, getting close to that number. So people are having to do it. So that is loosening up things a little bit. Rates, I think, like you said, rates continue to be historically low. I mean, in the 6% rate, that's normal, right? Like, you know, the stuff that we saw during the COVID era, that's just not normal. I mean, people just love that it was at that rate, and a lot of people bought, but that's just not normal.
right.
So prices continue to be high, inventory continues to be tight, so the market is still tight. You know, and in our particular area, you know, we have some layoffs happening and things like that, so that's also impacting the market. But I still think this year it's starting to look, at least in our area, January numbers were higher than last January.
Yeah,
So I'm going to look at February numbers. I think the trend continues. So yeah, I think the market's still pretty good.
Yep. Time to look at that bridge loan.
Yep.
Time
Yes,
to look
sir.
at that bridge loan. You know. So,
Yeah. Yeah.
But
yeah,
I think we're kind of seeing the same thing as far as you know.
Yeah.
But I think nobody has a crystal ball, right? Hey,
Nobody
people
has a
said,
crystal ball.
Is now the time to do something? I mean, you really don't know until it. But I think we might look back at the last year or so period of time when rates were at their highest as the best time
That's the
to
best
buy.
time. Yeah, for sure.
I think everybody's waiting. Everybody's waiting for rates to come down. Maybe that magic number is 5.99. I don't know what it is, but you know, just based upon the inventory and where rates are, I think we might look at the last year and a half as maybe the best time to buy a house.
Yeah.
Everybody's waiting for rates to come down, and with that pent up demand, I mean, I just think that the market's going to get, when that does happen, when we do get, and rates are going to come down at some point.
Yeah.
It's going to be so competitive. You're going to have a bunch of extra money.
Yeah.
You know what I mean?
I think we're going to be sitting here. If the rates do come down, prices will shoot up even further. And we're going to be sitting here discussing how, you know, you could have bought that home at the beginning of the year. Even though the rates were higher, you could have bought it for less and then refinance.
Yeah, refinance. Absolutely.
Yeah.
That's a smart play.
I mean, I know. Again, if you've owned your home for a while, unless there is a historical drop in rate, you don't really want to refinance, right? But in a case like this, if it's short enough, refinancing is ideal.
Yeah, you may want to go back. There's all kinds of options. Maybe you've been in your house for 2 years, and I'm not one to. I'm a little bit different about how much equity someone has in their home. I mean, having a ton of equity sounds great,
Right.
but if it's tied up and it's
If you
just,
can never use it, yeah.
well, not never, but it's you're going to pay for that. But the idea is, for me, is to look at that and go, hey, usually around, depending on the scenario, 0.75% to 1% lower in interest rate. It's usually going to make sense for people to look at that and go, hey, what are my savings going to be?
Yeah.
And going back to a 30-year mortgage, you don't have to do that. If you've been in your mortgage for 4 years, what's a 25-year loan? What's
Right.
that rate?
Right.
What's my payment going to
True.
be? There's lots of people that, again, I'm not one, you might have somebody wanting to do a 15-year mortgage and chop 2 or 3 years off the life of that loan. So
Right.
there's a myriad of options, and people need to get with a professional and look at that.
Yeah, and then take a look at it, talk about it, tell you, here's my situation, here's what I got, tell me what could work for me.
Right.
Yeah,
Absolutely. Yeah.
Yeah.
So
If somebody wanted to tap, you mentioned the equity in your home. If somebody wanted to tap into that, HELOCs.
yeah,
You work on those?
Yeah, we do. Home
Okay.
equity line of credit.
Okay.
We can definitely do that. It's
What do rates look like on those?
I think you could probably find them in the 8% range,
Okay.
or approximately about. I'm mainly putting people in their homes.
Yeah.
With first.
Well, I asked because I had a friend that mentioned that a couple months ago. He has a daughter who's getting married, and he wanted to pull some money out of his equity to pay for the wedding.
Oh yeah, sure.
Yeah. So I was like, that's and we were talking about the HELOC versus a second home, a second loan.
Right.
Where a second loan, as we know, is you get the money, all of it, and then you pay the loan on the entire amount. Whereas a HELOC, it's sort of like a credit card against your home, right? So where you get it's a equity line of credit, right?
Right.
You get sort of like you pay on what you spend.
Yeah. You could. And that's where it's a loan to value type thing that they're going to go up to. If you need $50K, it's basically like getting a credit card for $50K, or you can just take it all out, put it in a bank account, and have it there if you know you're going to have expenses that are coming up, like a wedding or college,
or anything.
And I'm dealing with that.
No, I'm just kidding.
Yeah. I sold a boat and
or golf lessons that I got to pay John to give me some golf lessons.
I'll give you a couple for free after that.
I'll take the free ones.
Yeah. Sure.
When you see my swing.
I've seen it.
Oh, that's
it's
right.
Not that bad. It's not bad. It's actually really good, man.
I just needed to go straight.
Yeah, well, we're gonna help you with that.
I need help on my game. Yeah. Anything else that people should know about your team? Actually, just let's go ahead and give people your info. How can people reach you? What's your phone number?
Yeah, phone number is 571-212-9281.
Say it one more time.
571-212-9281.
Okay. What's your email?
And my email is jwalowac@theyeteam.
@theyeteam.
Yeah, .com.
Okay. So. You know what? I'm going to put that down on the description on the podcast so that people have it. But yeah, man, awesome. Always having you here, talking and catching up on all things mortgages. I appreciate you coming. Hopefully you can make it back. Obviously I know the spring is busy, but hopefully I can have you back in about a month or so. If I get enough questions from people, I know people are, will probably shoot me some questions. Maybe I'll have you back and answer some people's questions.
Sure. My pleasure, man. Thanks for having me. I think this is a second time, so I got to be doing something right.
This is the second time. Let's get you back for the third time.
Yeah.
This has been great for myself, for John. Thank you guys for tuning in, and we'll see you at the next one.